everyone, and welcome to, well, it's the third of our webinars today for David and myself. I know for some of you it's the first time that you're joining us, so if it's the first time, the second time, or even the third time, it's lovely to have you here. I have to say, I know David normally comments about the weather, but I just had to let the dog out, and it's freezing out there. It's absolutely freezing cold, pouring with rain. Really not a nice place outside, so much better to stay in and look at the markets. It's all because it's been hotting up today, and we'll look at the charts later on. Right, but before we start, as usual, we do have to start with a disclaimer. As you know, this can be, well, trading can be very risky, so please don't ever think of using money that you cannot afford to lose. And as I said, David is with me. He's sitting not opposite me, but over to my right. We've changed the configuration of our trading room recently, and as always, we will be looking at the markets, the charts, through the prism of volume price analysis with our fantastic quantum trading tools. And the methodology that we use to analyze the charts, deconstruct the charts, is volume price analysis. And I know many of you who come along to these sessions have either read the book or come across the methodology in the past. But if you haven't, the book is available up on Amazon. And I'm really proud. Both of us are very proud to know that it's had, you know, how many 5-star reviews has it got now, David? A lot. 300, yes, which is really plus, which is fantastic. And you know, I'm always thrilled to hear from traders, both retail independent traders and people on the other side, if you like, of the wall, in inverted commas, the professionals, as it were. But we're all professionals these days because we all have the same data, information. Perhaps, you know, some people might get it a bit faster than others, and it's really very gratifying to know how the methodology has helped them, how they've taken that methodology and really made it their own, because that is what you do with volume price analysis. It's the 5 pillars of volume price analysis, and it just is your foundation. What you do with it thereafter, you use it in its purest form, or you integrate it with standard indicators or with our quantum indicators, is very much up to you. It's not a case of, you know, our way or the highway, as it were. And what we've also done is we've bundled that book with another book which gives lots of worked examples, because there are some examples in the book, but one of the emails we always used to get was, well, we want to see lots of examples. And the one that's put together in this particular bundle, there's over 200, and it's stocks. There's some indices in there, and there's also some commodities, and it's across all the time frames. So it's the faster time frames and the slower ones as well. Because with VPA, once you get to recognize the patterns, the relationship between volume and price, it just happens again and again and again. And as I said, the best way is look at the examples and obviously, you know, see if you can see in those examples in the actual live charts and live markets. As I said earlier, we also have developed a set of tools and indicators for trading all markets. But what we're going to focus on in this particular session, we look at what we call day trading. We're looking at the futures, and we're going to look at some commodities today, particularly oil, given what happened this morning. And the tools we've developed for day trading, then not only for time-based charts, but also for non-time-based charts for both tick and Renko. And you can buy the indicators. There are from quantumtrading.com. And the little tool, the tool set that we use here is actually from NinjaTrader. I know I have MT5 up because you can trade these instruments on the MT5 platform. It's a multi-asset platform, but we're really going to look at NinjaTrader. The whole tool set that we use here comes to £749. That's $49. I do beg your pardon. That's the complete package, but you can buy just individual ones or bundles, and there's lots of advantages to buying the complete package. For example, when we develop new indicators, they're automatically added to them, or you could just start from one and then you can upgrade as you see fit. All the details on all the indicators in the platform platforms you can find at quantumtrading.com. We are working on TradeStation at the moment and really very excited about that. If you've been on my blog or on the Quantum Trading Facebook page, you'll see there's been a couple of little screenshots of what the indicators look like on the TradeStation platform, but we do have quite a lot of work still to do on that. And finally, you can catch up with my thoughts, views, analysis at annacooling.com, and you'll find the details of all the books that are up on Amazon at the moment. So while I sort myself out, because there's quite a lot that we need to cover in this particular session, I'll just pass over to David.
Thanks, darling, and a very warm welcome to you wherever you are in the world. I hope it's a bit warm than it is here because it's freezing. And it's supposed to be summer. It's a British summer. There we go. Good to have you with us today. Anna's just sorting out one or two bits and pieces over there. If this is your first time joining us, very warm welcome. And I know we've got a few regulars in the room as well, so welcome to you too. If you have any questions, we're happy to answer them. If they're short questions, we will answer them in the chat box. And if they're longer questions, we will answer them on air. We'll focus on NinjaTrader platform particularly. I know I'm going to switch back to Anna in a moment. She's got the MT5 up, but primarily we'll be on NinjaTrader. I've got the YM running across the multiple timeframes. I've got it running on tick. I've got the, I think I've got the ES on tick, so we'll have a look at that as well. It's another day probably of a fairly congested price range, so it's possibly going to be very much the same as last week, but we'll see what develops as we get underway. So I'll pass back to Anna and be back with you shortly.
One of the reasons is actually there's really not a lot going on in terms of fundamental news. I mean, well, not till 6 o'clock our time. We've got the 30-year bond auction. Obviously, bond market's very important at the moment with what they are signalling in the sense of there's no inflation, you know, there's no possibility of interest rate rises. In fact, it's the opposite. Certainly now in the US, as well as we've had an interest rate cut in Australia. We've had the unemployment claims, and we've got natural gas storage. So, as I said, a very thin fundamental calendar today, but that doesn't mean that there's not stuff going on in the background. But before we just go on to the next thing I wanted to say, I hadn't realized this. I had an email from Forex Factory, who from someone who goes by the delightful name of Twee, which I thought was rather sweet, and who told me that actually you may not have noticed this, but up on Forex Factory here, they have actually started a new site, and it's called Metals Mine, and it's really, you know, based on the same principle, the same template as Forex Factory, but it is dedicated to the metals market, obviously gold, silver, and all the metals in the same format as we have on Forex Factory. I don't think anyone else has done anything like this, so really useful if one of the metals commodities is something that maybe you're interested in and you know, would like to know more about. What's really interesting also is it gives you the kind of information that you wouldn't normally come across. For example, the LME, the copper inventories. Copper is one of those commodities. It's a bellwether for sort of global economy. I know there's been a lot of manipulation in copper with stockpiling, and you know, China has a huge stockpile. I think at one point there's so much copper they were going to use it like gold. You know, it has a sort of use it as a collateral, as it were. I haven't had a chance to have a look at you know, in detail, but it looks pretty cool. There's as always at the bottom, if you open any of the let's go down to the bottom. Yeah, there's obviously the news stream is tailored towards anything that's to do with the metals and mining. So you'll find things on the mining places like Ecuador. That's very interesting. A top world copper mine. I mean, we do cover a lot of this in another book that we've done. It's called The Three-Dimensional Approach to Forex Trading, which it is about Forex, but it covers all the fundamentals and the related markets, which actually are applicable to whatever you trade these days. So just something I wanted to point out to you. Having mentioned China, obviously we have the G20 coming up, and we've got this ongoing trade war. It's not really, well, it's a kind of skirmish at the moment. Is it a trade war? Can you use the word war? I don't know, but anyway, certainly between the US and China. As we all know, there's been no resolution, there's no deal, threats of tariffs, threats of this. It's really not a good not a good sign for anybody whenever the word war is used in any context. But there's something it's the situation is this: in the media, if you read the sort of various reports about the situation via China and the US, is, well, who is, it's like game theory, who is ahead, if you like, who's doing better in this space? Is the battle going more, is it favoring the US or is it favoring China? And there's this constant backwards and forwards, and really at the moment nobody knows. Does the US have the upper hand? Well, maybe short term, does it have the upper hand? But what about long term? On the US side, Donald has an election to face next year. So will he really want this to drag on for months and months and months, going and, and having the problems that the trade war is causing, the sentiment that's causing in the markets, i.e., it's risk off. Investors are very nervous. Nobody wants to be in this very uncertain environment. Although trading and investing is uncertain by definition, you're just making it more uncertain. Or is it China who's really got the upper hand, if you like? Because if you think about it, he's president for life. He's not going to be voted out. He has, if you like, time on his side. So can he afford to sit back and watch Donald implode, as it were, and basically have to come back to the negotiating table because maybe the American economy will take a real nosedive? Who knows? That's the kind of landscape against which this battle is being fought at the moment. But may I draw your attention to an excellent book by someone called George Magnus. He's actually now a professor over in Oxford University, but I think he was he knows everything there is to know about China. There's this book called Red Flags: Why Xi's China is in Jeopardy. And it's not something that's going to happen tomorrow, and it's not something that's going to happen next year, but it's just useful to have more of an understanding of what makes China what it is. Where does it come from, and what are the challenges that it faces in the future? Now, the book I suspect is fairly sort of not heavy going, but none of us have a lot of time to really delve into books such as these, brilliant though they might be. What's really good is that George has been out and about doing a lot of podcasts lately. This is one that he did with Bloomberg, and I've been listening to it, and I have to say it's very, very listenable too. And it just gives you, I think, that extra bit of information, that extra bit of background, so that you can judge the comments that come out about the trade wars. You're seeing it, you're understanding it from a position of much deeper knowledge than the average person and even the average journalist that is out there. There are some really scary numbers with China. All the numbers are scary in China, but just to give you an idea, David probably don't know, and why would you know this, but his late father was a classical musician, as was his late mother. And he was a player in the BBC Symphony Orchestra. And many, many, many years ago, the BBC Symphony, correct me if I'm wrong, David, were they the first orchestra to tour China? There was a cultural revolution in China. Those of you may know that the middle class, as it was completely decimated. Everyone went back to basics, as it were. People were banished to the rural areas, and basically China really cut itself off completely. But there came a point, I think it was after Nixon, wasn't it, when he kind of opened? Yeah. Anyway, things changed. And it was really the start of China coming back towards the West, as it were, without being so insular. He, being part of the orchestra, toured China. It's the first Western orchestra to play decadent Western music in China. And one of the things he came back with the images, I think we've got some pictures of his time there as well. And we asked him, what was the the biggest impression that it made, and the biggest impression was that there weren't any cars, were there? There were just thousands and thousands and thousands of bicycles. So, and that isn't an awful long time ago. So, and just the sheer number of people, he was absolutely fascinated by it. And as I said, so that's less than a generation away. The number that really struck me in this particular podcast, I haven't listened to all of it, but at least I have listened to it, is that this is the situation with China. China is seemingly has a very strong position because it's got time on its side, so he doesn't have to face an electorate, etc., etc. But it has other issues, demographics being one. And what it also has is, can it afford to take on, the US in the sense that play this strong card, which is time, when something and a trade war is affecting them, it'll affect their GDP, it'll affect their exports, etc. They have 8 million graduates coming into the labour market every year, 8 million. They've got to be found jobs. And when you don't have, jobs, when you don't have, you don't have expectations anymore that you're going to progress in life, what does that create? What kind of environment does that create? You only have to look at what's happened in Greece. So although at the moment maybe it's evenly balanced between China and the US, and it's a case of, well, who's going to blink first? It's really interesting that possibly of the two, of the US and China, maybe China has some issues some challenges that it's going to have to address in the near future, not tomorrow, not the end of the year, not next year, but that's so maybe that could even impact them coming to the table and yet making an agreement. At the end of the day, the agreement between these two countries, it's like two people. Someone's going to have to compromise and not lose face, because this is what it's all about. And certainly with Donald not losing face and the Chinese, there's going to have to be a workaround so that they can both claim victory and possibly move on. And we've got the G20 later on this month. That's the big, main event, as it were, that we have to keep an eye on. Now, in the meantime, what's going on in the market, sort of, at the granular level that we are looking at, this is all playing out in background, but it has an impact on what is going on your charts on a minute by minute, day-to-day basis. But as I said, take some time out, have a listen to this. This is the Bloomberg podcast. There are 2 other podcasts that he's done on this book. It's absolutely fascinating, and I know you won't be disappointed. So I hope you don't mind I spent a little bit of time on that, just to sort of flesh it out for you. And as I said, in this business, we could never stop learning. That's what I want to say on that. Very, very quickly, David said on volume price analysis, what we're going to have a look at. We're going to be looking at a lot of volatility candles. What happens is, we had volatility this morning in the forex market, in the oil market, because of the situation with the 2 tankers which were seemingly attacked by some kind of torpedo. Oil price actually shot up. What happens is that the reaction is immediately price action goes out of the average true range. A really nice example on cable here on the 30-minute chart. What then happens after volatility, as the markets calm down, probably 7 or 8 times out of 10, the price retreats to within the spread of the candle, and it really does congest within that range, making it, it can be a bit tedious sometimes. But this is a lovely example on, as I said, the 30-minute chart of cable. It's also around the volume point of control. The chart we're looking at happens to be cable, but this type of price action, with the price action, the volume profile, the candle patterns, and perhaps there should be another element to VPA, which is which is volatility. So once you understand that, you understand what's going on, you understand the background against which this price action is developing, that should give you all the little bits and pieces, bits of knowledge that you need to actually move forward as a trader.
Anna said, is there anything that you want to add to that? I said, there's nothing I could add. So I must admit, she does find some really fascinating books, so I'd have a read of that. Right, let me just move the chat box down the way onto the charts. We're on the YM. That's the futures contract for... Or listen to the podcast, as Anna said. It's easier, so if you want a quick fix, listen to the podcast. We're on the YM. This is the June contract. Time frame wise, top line, I've got the 30-second, I've got the 2-minute and the 5-minute. Down the bottom, I've got the 10-minute, the 15-minute, and over across onto the right-hand side of the daily chart. It's really interesting at the moment. Sorry, I'm just going to adjust my microphone. It's really interesting at the moment because there's all sorts of things going on. You might be horrified by having a 30-second chart. The reason I have that there is purely because, let me just, sorry, I've got a problem with my microphone, that's better. If I just pop this up full size, this is what we're dealing with at the moment. We're dealing with these very narrow days. And when you're dealing with narrow spread days, then if you want to dig trades out, you have to go down to these very fast time frames. In addition to that, I'd also say it's very beneficial in terms of learning VPA quickly to sharpen your skills, because these come in rapidly. I had it on 15-second last week. I've scaled it down a bit this week to 30-second. I've got the 2-minute here. What we're looking at the moment is, and just to pop back to the daily, we did a post on this, I think it was yesterday or the day before maybe, about the precarious fragility of what we're looking at now. This very strong platform here, this is the accumulation distribution indicator, which develops these levels. The thicker the line, the more pronounced is the support in this case. And therefore, as we're approaching this, currently it's acting as support. We've tested again today. But if that breaks, then we're probably off down to the VPOC, down at 25,800. So it's very fragile at the moment. We've seen this weakness coming. We had 2 consecutive days of weakness. Effort to rise, falls back, effort to rise, fall back. Volume is not great on the daily, I must admit, but nevertheless, it's looking very fragile. Same sort of situation today. The market is trying to rally all the time. You can see it on the 30-second chart here. It's pretty weak, but what's more important now is on the 2-minute. If I just pop the 2-minute open, we had to get through. We've got so many levels up and down the chart to get through that it's really going to be hard work for this to develop, but it may do. What will be the key is whether volume actually delivers in terms of momentum and force to drive this market higher. We managed to get through this level. Literally, as Anna was talking, we were up here approaching this level, and we managed to clear that. So that's now acting as support. That's a pretty strong platform. We've got another one here, less strong, but nevertheless it's being tested right now. We've got another one up here, and then of course right up here we've got the VPOC as well. In addition to that, you've got pretty condensed volume all the way through this region, so there's no low volume nodes to offer any respite to this grinding move higher. And you can see what's going on over here on the 30-second. You know, we're trying to rally but falling back, trying to rally and falling back. And part of the reversal, which was picked up on the 10-minute, here we go, just broaden that out a little bit for you. There you go. This is the open at 2:30 our time. So as normal, volumes increased dramatically. So this is Globex, the electronic futures size. It doesn't invalidate. It just means that all this volume's come in and has compressed all the volume over here. So in terms of comparison, we're now looking at what's going on in this block of time here. Had the usual open, usual volatility, then we had the huge volatility spike to the downside. We had one volatility to open, another one trading within the spread and weakness, big wick to the upper body, rolls over, down into a big volatility candle. Now we're expecting a reversal back up into it, which we've got. But in addition to that, we've also got the volume point of control here sat at 26,080. So we're trading around that now. It's very, very narrow, contained price action. It's struggling to find some bullish momentum. You can see the amount of pressure that is weighing down on this market right now with all these levels. Very strong level of resistance here. Very strong level of resistance now over on 5-minute as well. Trading around the volume point of control. And it's all very, very compressed, trading in a range. What does that tell you? It tells you that you just, if you want to trade in these markets, then you're going to have to go down to these fast time frames. Because when all's said and done, this is a move from where? 26, from 95 down to 64. So it's roughly 30 points in there, which if you're comfortable moving at that speed, that's fine. It's there. Trend Monitor helps you to develop the trend. And if you're quite comfortable trading that sort of speed, then that's fine. If you're not, then it's a case of being patient and waiting for the market to break one way or the other. And it's then a question of defining the levels which will set your criteria for your comfort level, if you will, at which point you think, okay, fine, I'm quite happy with this. It's moved away from all this congestion. I've got decent clear water. I've got some sensible places to place my stop losses, etc., etc., etc. And then you're down onto the maybe slightly slower time frames on 5 and 10. You're looking for those levels for a breakaway. And in terms of moving away from this volatility candle, certainly looking at that, what you'd be looking at as an absolute bare minimum would be a break below 26,040, because once you're clean through there, you've got a nice chunk of low volume here. So the expectation for the market then is, given there's really effort to rally and it's very weak and weedy, then the chances are that when it gets to this level, the market will go through there pretty rapidly, because there's very little in the way of volume to present a barrier to the move lower. And you could look at volume on the histogram here in exactly the same way as you look at these levels here, which are price based. When you approach these regions, they're either going to act as a platform of support or they're going to act as a ceiling of resistance. Exactly the same with volume. If you get to these low volume areas, then the prices like to move through there pretty quickly, because there's very little in the way of volume to present a barrier. Equally, when you get down to these higher levels, you expect the market to struggle a little bit, so you want to see volume rising to drive it through those areas. It really is that straightforward. And it's one of the reasons we use the volume point of control. Not only does it give you the fulcrum of the market, which is here in where the market is congested in price agreement and volume is at its greatest, but it also gives you all these regions up and down the chart, which when they're approached for you as a trader are absolutely key, because they will give you a heads up as to what is likely to happen next. And that's really all trading is about. It's trying to pull in all those bits of information which will help you make a balanced, sensible decision, common sense decision based on analysis and not based on gut and instinct and emotion. So from a purely support perspective, in terms of where you would want to see a breach of support and thereafter what is the opportunity, certainly that would be a level to consider. You might want to wait till it actually clears the bottom of the candle completely, because it could well get through there and then reverse back inside the spread. But once it's clear of that particular region, then you're moving lower down the chart. You're back to 26,000 maybe. You've got some pretty light potential support here, very light on this one. This is one that's only been tested once. This is a couple. This is 3 or 4, much wider, as you can see. So in terms of looking at this as an opportunity, if you said, well, you're going to get in somewhere between 20 and 40, then how much opportunity is that position going to deliver for you potentially before we hit some serious resistance? Well, 26,000, the market's probably going to congest anyway, because it always does around big numbers such as that. But if it goes all the way down here, you've got maybe 40 points. Now that may be enough. It may not. Just a balanced decision. That's a question that you have to take. But at least you're looking at the opportunity in terms of considering it from the chart and not from some absurd perspective of I want a risk-reward ratio, which I'm sure you've come across. People say, well, I've got to have 3 to 1 before I enter a trade. Well, you know, you may want that. The market may not want to deliver that for you. They don't care about you or what you want. You just have to read it off the chart in a common sense way, because the market delivers the information on the chart, and just use it. It's very, very straightforward, very simple. What we're seeing right now, just literally, as I said, honing your skills, VPA skills on a chart such as this, is very effective because everything comes at your speed. You can see on these last 2 down candles, you've got move to the downside, only 2 candles in this case, but we've got falling volume. What does that tell you? Probably tells you it's weak, because normally if that is going to continue, you want to see rising volume, falling market and rising volumes, because a market requires effort to fall in exactly the same way as it does to rise. Now we've got 2 bars of rising volume, rising price. We're running into some resistance. We want to push through that. Need to see the volume pick up a little bit. Okay, it's dropped away, not terribly strong, so it's not a very strong reaction. Ton of volume sitting here. Low volume nodes right up the top here. Lighter volume here. And scattered price resistance up and down the chart. So you know, the response here is pretty weak. You're not expecting that to develop very strongly. And given you've got the volume point of control here, moreover, you're expecting it to congest around this region for a while longer until volume actually picks up. Still sitting on that platform there. Let's have a look at the other time frames, see what they're telling us. The VPOC is just in evidence everywhere at the moment, and if and until, and indeed it may not break away from this, it may sit here all day. Sometimes they do, and that's just it. You just have to be patient and wait. Let's read this chart. Platform of support here coming in to be tested again. Looks like it may break through there. See what the volume's like. Okay. Oops, sorry. Screw that back up again. There we go. Much higher volume on that, so decent selling under that candle. So we've now got rising price, rising volume, falling price. So that is indicative of selling pressure, which is telling you that the market should go further still. Light volume here, very little in the way of price support. Okay, now we've got a bit of buying coming in under that candle. It's a doji, maybe a little bit of buying in there, a little bit of buying and selling. It's closed at the open pretty much, so it's hard to interpret. The doji candle is not indicative of anything really other than congestion. It's not really giving you a signal to a trend reversal or anything other than the fact that we're in a congestion phase. Okay, lightweight volume under there. So the selling is really not delivering at the moment. But what's interesting is you've got the trend monitor here. Now the trend monitor really does help you to keep you in through these trades. If you're trading this, the areas where you're always going to suffer is when you get these reversals. You get the reversal comes in and you've maybe taken a few points out here and you think, oh God, you know, I had 50 points in the bag and now I've only got 35 or something. What the trend monitor does, it smooths all that out. It tries to help to keep you in, to tell you when a trend is actually reversing and when it's not. The dark transitional color here, the darker red, is just saying, well, there's weakness in the trend, but it hasn't actually transitioned to anything yet. And indeed, it's come back out the other side, back into bright red again, so it's held you in through that. In addition, the trend line here never got up to the fulcrum of 0 and is now starting to dive down again. Now, that's obviously on the 30-second chart, which is pretty fast. But then if that is true, what you'll see over on the 2-minute, for example, is exactly the same. It's been bearish. In this case, we went into the darker red. We even tiptoed into darker blue here for a period, but then we never got to bright blue. We've just come out the other side into dark red and back into bright red again. It's just confirming again that the trend is still bearish. It's a minor trend, it's not a strong trend, but nevertheless, if you're trading this, you need to have that information because otherwise you'll get bounced out all the time. And it just helps to keep you in through those phases of price action which reverse against you, which happen in all time frames. And they are the absolute key to success in this business because it's about the financial aspect of trading. If you can stay in through those moves and maximize what you're taking out of the market, so you've got a few big winners which counterbalance the greater number of smaller losses, that will move your trading account forward. And that's what the trend monitor does for you. It helps to smooth them out, to just give you that confidence to hold a position through those horrible reversals and pullbacks which we all suffer in every market. Now we're starting to break down nicely. Trend monitor is bright red, so that's fine here. We're bright red here as well. It's just reflecting the fact we've moved it from 30-second into 2-minute. It's nicely held here up on 5 and it's still holding down here on 10. Not a flicker of a change. What's also interesting now down onto the very slow time frame, comparatively at any rate, of 15-minute, you can start to see here we're starting to see a transition into a darker red, and ultimately, obviously, if this breaks down completely, this will move through into bright red in due course. The issue, and as intraday traders, you've always got to be aware of it. I know it might seem odd going to the daily chart, but part of the reason this market may bounce around the 26,000 is because you've got this absolute wedge of price-based support here, which is very, very strong. So it just gives you that heads up that even as an intraday trader taking 30, 40 points out of the market, you've got to be aware of what's ahead in terms of all the various time frames, and particularly the daily, because the slower time frames will always trump the faster time frames because they carry much more significance and weight, which makes sense when you think about it. If you've got some congestion on a daily chart or a very strong platform or a ceiling of resistance on a daily chart, that is going to carry hugely more weight than the same on a 15-minute chart or a 5-minute chart, because it's got time there. It's been there for a long time, and therefore any of those levels will carry that much more significance than on the faster charts. So you've always got to be aware what is going on the slower time frames. I would say have them all up, but certainly have a daily for context at any rate. Okay, what's interesting, we've seen some buying coming in under this candle. You can see it there, it's self-evident. What happened? The market fell. We had a big up move in volume, and the market's recovered. So as soon as we see that, what are we expecting? We're expecting the market to rally, which it's doing. That's what you expect to see. That's what volume tells you. Volume reveals the truth behind the price action. It's as simple as that. And when you see that coming in, it's just a classic example, big move. If that was a genuine move lower, this candle should have closed wide and down. It hasn't. It's closed pretty much near the open and back up with a deep wick to the lower body with a ton of volume under it. That has to be buying. What else could generate that sort of price move? That's it. It's as simple as that. So when you're trading this short, when you see this come in, you know instinctively that the market is going to rally. Now, it may not rally far, but the mere fact that you understand that and know it is going to help you with your emotional response to that move, which is, oh my God, I've lost some profit, you know, panic, panic, panic. At least you see it happening in real time. So it doesn't come as a bolt out of the blue, and suddenly you're sitting there wondering what the hell's hit you. Now you've seen this rally to the upside. We've got a ceiling of resistance in place here, which looks pretty strong. The volume here is falling away, so it doesn't look like a terribly strong rally. We'll see, but it's certainly not shaping up that way. Maybe some transitional changes on the trend monitor. We'll see. Let's head over onto another candle. Let's go have a look at the 2-minute. There we go. Just pull that out wide. There we go. Similar sort of picture here. We've got some buying under here. The market's fallen, rallied, up body on the candle itself. Decent volume under that one. So yeah, there's certainly some buying in there. So we're starting to see it rally, which is what we expect to see. And on the 5-minute, deep hammer candle, big wick to the lower body. Not surprised to see it rally. So, you know, it's all pretty much what we expect to see. If we go back down onto the 10-minute, where we were looking at the volatility candle, have we breached this level? It went through and it's now back above it. So we still haven't broken, had to close below this level of 40 or 35 or wherever you consider is a good place to get in. Trend monitor is bright red, it's fine. But we still haven't cleared away from this this volatility candle that's been sat there for a while now. And if this is going to shape up into a true reversal of any note, then you've got to get through here. We've got to get through the volume point of control. We've got to see certainly more volume than we're seeing at the moment to drive this back higher. So all things being equal, this looks pretty weak at the moment. You just have to sit tight. If this transitions through to blue, then you know we're into a trend reversal from primary to primary. In other words, from bearish to bullish. But it doesn't look as though it's shaping up that way. It may do, but it doesn't look like it at the moment. Just head over onto the tick charts for a moment. I've got the ES over there, I think, just for a change of scenery. There we go. And this is very, very sluggish. You may not have seen tick charts. This is the ES. This is the most volatile and also the most heavily traded of all the primary indices. and it has all the trading algos are in here, which is why you get the extreme volatility at the open, because that's when they're all kicked off. The actual tick charts themselves are, this is running very, very slow. You may not be able to see this, but this is 987, or the actual is 1054, 3100 down here and 2490. This is very, very sluggish for the ES. These numbers should be several thousand, and this can go up to 15 or 20,000 on a busy day when the market is really, really moving. So at the moment, they're pretty sluggish. The reason we developed this was twofold. First of all, to develop the actual, or to derive and deliver the tick, correct tick speed for each particular time frame. This is a 1 minute, this is a 3 minute, and this is a 5 minute. And what the indicator does is it calculates the optimal tick setting for the charts, which are then, as you say, I've got 3 here. Because otherwise you have to guess. Do you set it at 200, 300, whatever? And it's one of the facets of trading on a tick chart, which is time independent. On all of these, and it applies to Renko as well, you see the raw momentum of the market. You see how quickly the market is moving. Because if I just change this over, this is 987 now. I'm just going to change them over there so they're running at the right speeds. This one is 4181, that's okay. This one has dropped away, 2584, just change that over there. Every instrument has a different characteristic, it has a different character. It will require different tick settings, and these change during the day as well. As you can see here, these are constantly moving up and down. What it also reveals is when the market is sluggish, when we get these phases of red price action, the market is very, very sluggish. It's not going anywhere. Tick activity is falling away. When you get the bursts of green activity, then that is an increase in tick activity and participation. And the orange is the general momentum of the market. So when it's moving at, as it says here, slow speed, it's a warning that this is very sluggish, and just be careful. And the daily chart for the ES, as you can see, is very, very similar. Hasn't got that same level of, sorry, let's just move that up a little bit. Very similar in context to the others as well, the ES, the NQ, and the YM. I've got another chart. You'll see that the daily charts are pretty much the same. They're almost identical. So that's giving you a sense that the market is very sluggish. That's on the ES, and exactly the same on the YM. Lacking momentum. Lacking participation. Effort to rally here, decent volume under it, wick to the upper body, doesn't look strong. We're just, okay, we're just peaking below. We're now through this region. We're through pretty much the bottom of this candle. We're moving back to retest that level that we've breached. And if we break away, then that may be sufficient to get into the market and give you the comfort level of an entry point, if you will, once we've moved through that floor. Trend monitor's bright red, as you can see, continuing to hold. Let's put the 30-second up again. Normally in a move to the downside, you expect to see this move rapidly, heavy selling, price waterfalls and all of that, because generally markets move more quickly to the downside than they ever do to the upside. I have a bias to the short side, as many of you know, and that's the reason, because markets move very rapidly once they get underway. This is a very sluggish bearish trend, as you can see, constant rallies, interruptions, and it's not a smooth move lower where you have 3 or 4 or 5 candles one after the other. It's bang, 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 and down the market goes. Got some decent buying under that last candle on 2, under this one. Wide body, good volume, decent buying. Expect the market to rally off that. No wicks to the upper body, so it's pretty clean. And the commentary I'm doing here on the 2 minutes, exactly the same as you would have on any other time frame chart or in any other market. The volume price analysis applies irrespective of the market. This is the sort of price waterfall you're always looking for in a move to the downside. 4, 5 or 6 candles, bang, 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 one after the other. And then you see the stopping volume or buying coming in. The market, the brakes come on, the buyers come in, market then rallies, and then you just get the next phase down. It's what we're looking for the whole time. This is classic falling market, rising volume. That's what you're looking for, because as I said before, it takes effort for a market to fall in the same way it takes effort for the market to rise. We're back up around the volume point of control on the 30-second. Just go over and see what's going on in terms of commodities. As oil, as Anna mentioned, was an interesting one. This was the reaction at 8 o'clock this morning to the news. 7 o'clock, beg your pardon. Lots of volatility, a very, very rapid move high. I've got this huge volatility candle. I think it was over $1 or so per barrel. It's gone up. And now we're trading in a tight congestion range. And what's interesting about it is that if you look at it on the daily, and I mentioned this morning in the Forex session, if you look at this candle on the daily, you'd be mistaken to think that this was a steady day of price action where, for whatever reason, the oil prices were rising. It's purely come off the back of that knee-jerk response to what is going on in the Gulf. And I'm not saying it's invalid, and I don't have an answer to this, I'm just making a statement that when you look at charts historically, you will not have that information to hand unless you happen to be in the market every day as we are. Then you'll know on particular days this happened, that happened. All I'm saying is that when you look at a bear chart purely with a view historically, you wouldn't know that this day, this candle was generated, the bulk of that price action was actually generated in a very, very short space of time. So it wasn't an even day of even priced action rising throughout the day. It was just a knee-jerk response. Market went bang, up it went $1 and a bit, and now we're starting to see it come off a little bit. The general market sentiment for oil is still pretty bearish. Having said that, oil is always exposed to all the other factors of geopolitical, OPEC and everything else. So you can never, you've always, when you're trading it from a technical perspective, you've always got to have half an eye on all those other aspects as well: supply, demand, tariffs, and everything else that goes along with it. But it was certainly interesting this morning. And again, it just highlights the power of the volatility indicator. Once these trigger, then you expect the market to consolidate. Didn't on the first one, did on the second one. And we're still trading pretty much in that tight range.
If you look at the 30-minute chart, I think it's better.
Anna says it's better on the 30. Let's just flick that over to 30. There we go.
Spiked up.
Okay. Yeah. And at the top of the chart there, you can see, we've got rising volume. Then you start to see the weakness coming in. Effort to rally. We had an effort to rally here. It carried on for a little bit. Volume was not great. Then we get a pick up in volume. Now we're starting to see a reversal. If that reversal is going to continue, we've got to get through this level. We're down into pretty congested volume below, down onto the volume point of control as well. These bits of news are manna from heaven for the market makers and the big operators, because they give the opportunity to jack the market around very quickly. The emotional response you will have as a trader is to jump in and not lose out. That's why they're designed in the way they are. That's why volatility is so important, understanding when it's in, what's happening, and what the expectation is that the market will either congest or reverse. And the reason it does that is because it's a great way for the big operators and the market makers to make money through the pressure of emotion, of you jumping in and then regretting that decision and either getting stopped out or closing out the opportunity because you're just being pressured by the period of time that the market then congests. It's all about emotional pressure. Got gold running underneath that one. Let's just go back onto the YM, see what's happening. Drop that out the way. Okay, on the 32nd, we're now down to, where are we? 2018, 26018, almost got down to 2600. Broke away, ton of volume coming in, you can see it here. Volatility broke through, went through that one, loads of volume driving it lower. You know, it's nice bearish price action, heavy selling coming in. And as I say, when we get down to 26,000, you're almost certainly going to see it congest for two reasons. Firstly, you've got because there is that very strong platform of support sitting on the daily. And secondly, because around these big numbers, you'll have a whole phalanx of orders sitting there waiting to be triggered either above and below it. So it's almost certain that you'll see the market congest at these big numbers, 26,000, 26,500, even the hundreds as well. To see what's going on the slightly slower time frames. As you can see here, we did have a transition. What's interesting about this move is we had a transition of the trend monitor here on the 32nd. It did actually go into blue. Then it came out again pretty quickly and back into bright red. No flicker on 2, no flicker on 5, and 10 minutes just solid red all the time. It just helps to keep you in through all those reversals and pullbacks. It's so powerful because it's checking on the trend the whole time. Is this a genuine reversal or not? There's another indicator we have which works with it, which is the trend dots, which I haven't got on here just for clarity. The trend dots transition first because they're very close to the price action. The trend monitor transitions second because it takes a more considered view of price action. And you can see the way this is all shaping up on the daily chart. You probably can't see it there, just ease that out maybe a little bit more, but this is what we're looking at. This is the candle of the day, this rally here. We're literally trading back at the open here. We've got a tiny little wick underneath, and this is what we're now sitting on, this great big fat red dashed line of possible support from the accumulation distribution indicator. Now that may or may not hold. If it holds, the market can rally off it, but I tell you, if that is breached, then that is going to be a massive ceiling of resistance overhead. And all things being equal, you expect to see the market at the very least move down to 25,800, back to the volume point of control again. And when you look at the nice thing with obviously multiple time frames in, you look at this candle here, and it's not self-evident when you look at that group of candles over here that this is what is going on, but this chart tells you what is going on very clearly because you've got another little hammer, you've got a good lower wick to the body here, nice and deep, lots of volume coming in here, so we know we've got the buyers have moved in here to take the market back up again. You know that for a fact because the volume is very strong, it's well above average, so this has to be buying again. Therefore, the market's going to rally a little bit. And you can see the same thing going on 5. The fact the market didn't close down here, it bounced off 26, as I say, is partly because this is a big number and partly because you've got that strong platform of support in there. So the market's rallied. It's closed about halfway up the candle here with this deep wick, decent volume under there. So we know for a fact there must be buying in there because if there weren't, this candle would have closed down here somewhere, and it hasn't. It's closed back up. So the buyers must have come in. Don't know whether they at what point they came in, but they came in somewhere in the 5-minute time frame, and they've bought. And the other aspect of this, if you're looking to short the market and you're looking for entries, then you've got to start searching out those candles which will give you that clear signal that the market has rallied but is very weak, where you see an upthrust candle, for example, you get a little rally forms. I'll see if I can pick one out on here. If we get one, the market rallies, you get decent volume, you get an effort to rally, you get a wick to the upper body, and then it starts to roll. It's a signal for an entry if you're not already in a short position. Down on the 10-minute, we've got a long-legged doji candle formed here. You can see we've got almost symmetrical body in the middle and 2 very nice long wicks to either side. So what's that telling you? It's not telling you the market's going to reverse. It's just telling you that we are now at an indecision point. The market doesn't know which way to go. It's indecisive. We've had the battle in here, the tug of war, if you like, and now we're going to sit here and wait for either the bears or the bulls to come out on top and dictate the next phase of price action. So this does not on its own tell you anything about a trend. Bear with me a moment. I just need to take a slug of water.
Oil's not going anywhere at the moment.
There we go. Anna's got her eye on oil.
I've got it on the MT5.
She's got it.
Nice. There's 2 contracts available on MT5.
Okay.
So,
just as a complete aside, if you do not want to get into pure futures trading and but want to trade commodities and indices and indeed stocks as well, I would recommend MT5. It's a great platform. If you're familiar with MT4 brokers do offer quite a few of them, but the MT5 is really the true multi-asset platform, the sister to MT4. Using the platform is great. It's exactly the same look and feel. There's more bells and whistles on MT5. There's lots more timeframes to choose from as well. And the advantage is you don't need a futures account. You don't need a futures broker. And you don't need the additional margin requirements that all these contracts carry, because they can be pretty hefty, some of them. Let's just drop that back to where we are. You can see this little rally going on. And it's really all come about through this phase of price action here. You know, we saw it here. You don't see it so clearly, and it's why you need to really have a multiple time frame approach, because what you see on other time frames will help you to understand what is going on in your time frame. But it's really clearly signaled on this chart here with this candle and this ton of volume coming in. You know for a fact the market is going to rally. It has to. Now, it may move sideways for a bit before it rallies. In this case, it's pretty much got off the mark. Had one candle sideways. Now we're starting to tick up a little bit. And it all comes down to this chap over here. This huge, huge platform that may or may not hold to prop this market up. And of course, it also depends on what Mr. Trump's up to today. He's got his Twitter account open, which he probably has.
Well, he doesn't tend to Twitter about tariffs.
No, he doesn't.
It's only the weekend.
Yeah. There we go. I'm going to pass back to Anna. And
do you want me to wrap? You can wrap up.
No, that's all right. You can wrap up. So I hope you've enjoyed today, and it's certainly been interesting. It's tight trading, but all I would urge you to do, if you're not familiar with volume price analysis, to actually study it, and study it on fast charts, because that will hone your skills. Because chart reading is chart reading, and to be honest, it doesn't really matter what the instrument is at the top of the chart. It can be anything from a commodity to a stock to an index to forex, whatever, bonds, doesn't matter. They all work in exactly the same way, because it's down to your reading of volume and price, with the indicators then helping to support that analysis, and also, more importantly, helping to keep you in through those ghastly pullbacks and reversals that we all suffer. So thanks for coming along. I'm just going to pass back to Anna.
Just very quickly, this is the profile that I've put up for oil, and one of the things I mentioned, and David mentions as well, when we do our forex session, is having a set of charts that suit that you want to focus on for your trading. So what I've got here is I haven't got tick charts. I've got the Renko. I've got a 3-minute, I've got a 30-minute as a kind of a context chart, anchored chart, and I've actually got the daily chart for oil. But what's interesting with the 30-minute here, as we can see, very similar to what we saw on the NinjaTrader chart. This is this volatility candle that the third actually from this morning, following the news about the tankers, and there was an effort to keep on rising. We can see the volume. Really, there was no follow through on these up candles. Very, very poor volume on these 3 up candles. Then we get the sort of shooting star here with a reasonable amount of volume underneath it, and really, it's still trading within the range of this candle going right back to this morning. Now, this is what my context chart is telling me that I'm basically moving sideways on the 30-minute chart. What does that tell me on the 3-minute chart? Well, it's simply reflecting what the 30 is telling me, and that is horrible. That is really horrible price action. No volatility in this congestion, but up, down, up, down, up, down. Very, very tricky trading, if any trading opportunities at all, because it really hasn't decided which way to go. And reflected on the Renko's, we can see here it goes down a bit, comes up a bit, down a bit, etc., etc. So nothing like this nice trend that we had when it was going up earlier. What's also interesting about the move higher from this morning, we had this pullback, but actually the Renko kept us in, and certainly the trade monitor kept us in, because there was no move to a bright red, and then that's the topping off, as we saw earlier, on the shooting star. So it's understanding the price action on your context chart, looking at what's going on the daily, then what is happening on the context. It determines the type of price action you are facing in the faster time frames. And if you see congestion on your anchor chart, I just happen to have the 30, you could have, depending on the combination of time frames that you're using, that would really, what it does, it tells you what you're likely to face in terms of price action, but it also tells you something much more important, and that is, if you are in whipsawing action, or things kind of moving sideways, the risk on any trade you're going to take is going to be that much higher, because you've got no clear direction. You could get into, you could possibly sneak a few points or a few pips, but you're not going to be in there very long. And because you've always got this, you're always kind of battling the price action that it's going to reverse at any minute. You could then say, do you know what, this really isn't for me. Let me go and see. Let me go and find something else where there is some kind of clarity in terms of direction, because there is stuff out there. It just doesn't happen to be in oil at the moment. And my last thing on oil, there's a post on oil on my site, and not wishing to be overly cynical about things, one of the things we said on that post is, you can see here, back down to $44 a barrel. This is not a good price for any of the producers. It's way below what they call their break even. So in a horrible kind of way, the attack this morning, well, it's done the producers a bit of good, because they want these prices to go higher. In fact, the weekly chart for oil looks quite interesting, because we've got a hammer candle there, and we have a ton of sort of buying underneath there. This is last week, and let's see what happens by the end of this week on this candle as well. What's interesting is also on this chart, on the volume point of control there. So if it manages to get over that, that is going to give it at least some kind of platform of support. But the break-even prices, you can find them on the internet. You can look them up. Each producer country has its own. I think even Saudi, gone are the days when it can stand $35 to $40 a barrel. It needs oil to be much higher. Anyway, that's what I've got to say about that. Anything else, David, do you want to add to that? Lovely. Right, we are back next week. Enjoy the rest of the trading day, the rest of the trading week. And if you've got any questions on anything VPA related, indicator related, then you can either drop me a line at anna@annacooling.com or david@quantumtrading.com. So thank you so much for coming along. It's been great having you here. We've enjoyed it. I hope you have. We'll catch you next time.